We live in an era of digital elegance. When you open your banking app on a Monday morning to check your portfolio or move funds, the experience is seamless. It's a world of haptic feedback, Face ID, and sub-second response times. For the modern investor, especially those of us who have watched the transition from physical ledgers to the cloud, it feels like we've finally arrived in the future of finance. We see the front end and assume the back end matches its sophistication. But there is a profound and increasingly dangerous paradox at the heart of global banking. While the glass of your smartphone is 21st century state-of-the-art, the engine moving your money is often a relic from a different epoch. You are interacting with a digital veneer, a beautiful skin stretched over a skeleton that was built when the moon landing was still fresh in the collective memory. Behind that sleek UI is a world of green screens. If you were to walk into the data centers of the world's largest Tier 1 banks, past the marketing displays and the glass-walled offices, you would find the mainframe. These are the massive, monolithic machines that process the actual truth of your account. Not the cash balance you see on your phone, but the hard ledger of record. The uncomfortable reality is that our global financial skyscraper is built on rotting wooden pilings. These systems were designed in the 1970s and 80s, meant to last perhaps 15 years. They have now been running for 40. As an investor focused on the long-term horizon, you must ask yourself, what happens when the foundation can no longer support the weight of the modern world? We are not talking about a temporary market dip. We are talking about a structural expiration date that the market has yet to price in. To understand why we are here, we have to go back to the 1960s and 70s. This was the golden age of financial architecture. It was a time of incredible engineering optimism. Banks needed a way to process massive amounts of data with absolute precision. They turned to COBOL, the common business-oriented language. At the time, COBOL was a masterpiece of efficiency. It was designed specifically for business. It handles decimal arithmetic with a level of accuracy that many modern programming languages still struggle to match. It was the bedrock of the first truly global financial network. But this initial brilliance became a trap. The systems were so good and so reliable that they became mission-critical. And in the world of banking, mission-critical often becomes a synonym for too dangerous to change. This is the inertia of success. Because COBOL worked so well for decades, banks built layer upon layer of new technology on top of it. Instead of replacing the foundation, they built wrappers. They built interfaces that allowed the 1975 mainframe to talk to the 1995 server, which eventually talked to the 2015 cloud. The result is a geological record of computing history, all running simultaneously. Every time you tap your card at a coffee shop, that transaction likely travels through a dozen layers of technological history before it hits a COBOL program that subtracts $5 from your balance. The industry became locked in. The cost of migrating off these systems is so astronomical, and the risk of a total system collapse during the migration is so high, that for decades, boards of directors chose the safer path. Just keep it running for one more year. In finance, we understand debt as a tool or a burden. But in technology, technical debt is a literal liability that appears nowhere on a balance sheet. Think of it as a high-interest, uncallable loan. Every year a bank refuses to modernize its core plumbing, the interest on that debt compounds. That interest is paid in the form of maintenance. Current estimates suggest that some of the world's largest financial institutions spend up to 80% of their entire IT budget simply keeping the lights on, patching old code, and maintaining hardware that is no longer manufactured. This is a massive drain on capital. It means for every dollar a fintech startup spends on innovation, a legacy bank is spending 80 cents just to ensure their 40-year-old ledger doesn't crash. As a long-term investor, you have to recognize that this isn't just an IT problem. It's a fundamental drag on the bank's future valuation and its ability to survive a crisis. The danger of technical debt isn't just that it's expensive. It's that it's opaque. When you have 40 years of temporary fixes layered on top of each other, no single person in the organization actually knows how the entire system works. The documentation is gone. The original architects are gone. It becomes a black box, where a small change in a secondary system can trigger a catastrophic failure in the core. We've moved beyond the metaphor of a loan and into the reality of a structural defect. If you are holding bank stocks in a 20-year retirement portfolio, you aren't just betting on their credit book or the interest rate environment. You are betting that this invisible, unaudited pile of ancient code can hold together for another 2 decades of increasing digital stress. This brings us to what I call the talent chasm. Even if the hardware holds, the humans are reaching their limit. There is a small, dwindling group of engineers I call the silver-haired guardians. These are the men and women who actually understand COBOL and the idiosyncratic architecture of 1970s mainframes. Most of them are in their late 60s or 70s. Many have already retired, only to be called back as high-priced consultants because the bank realized no one else knew how to fix a critical bug. This is a demographic crisis. The knowledge of how the global financial plumbing works is literally dying out. Modern computer science graduates aren't learning COBOL. They are learning Python, AI, and cloud architecture. They don't want to work on a green screen system where one wrong keystroke could freeze $1 billion in transactions. The risk here is systemic. It's not just one bank. It's the entire interconnected web. When the knowledge base disappears, the invisible code becomes a permanent fixture that no one dares to touch. We are reaching a point where the people who understand the why behind the logic of our financial systems are no longer in the building. This creates a fragility that is hard to overstate. Imagine a Boeing 747 where the engineers who know how the engines work have all left the company, and the new pilots are only trained to fly drones. It might stay in the air for a while on autopilot, but you wouldn't want to be on that plane when the turbulence hits. For those of us looking at a 20-year horizon, this talent scarcity is perhaps the most sober reminder that the stability we take for granted is actually quite precarious. As we've explored the technical debt trap, it's clear that the issue goes beyond just outdated code. The real problem lies in the complexity of these systems, which have been layered upon over decades of bank mergers and acquisitions. This has created what's known as spaghetti code, where layers of incompatible systems are held together by middleware and wrappers, making total system visibility impossible. Imagine trying to understand a system that's been built upon over 40 years, with layer upon layer of complexity added on top. It's like trying to untangle a knot that's been tightened over decades. This is the reality that banks face when trying to modernize their systems, and it's a major contributor to the technical debt trap. As we can see from this chart, the complexity of banking systems has been growing exponentially over the past few decades. This is a major concern, as it makes it increasingly difficult for banks to maintain and update their systems, leading to a higher risk of failure. We've seen numerous examples of system failures in the banking industry, from the TSB and RBS outages to the Knight Capital debacle. These failures are often referred to as glitches, but in reality, they're structural failures of legacy logic under modern stress. They demonstrate the flash crash potential of 40-year-old math, where a single event can trigger a cascade of failures throughout the system. As we can see from this map, system failures are a global phenomenon, affecting banks and financial institutions all over the world. This highlights the need for a coordinated effort to address the technical debt trap and ensure the stability of the global financial system. So why can't banks just switch to the cloud and modernize their systems? The reality is that it's not that simple. Migration projects are complex and costly, and often require significant downtime, which can be catastrophic for a bank's operations. It's like performing a heart transplant on a marathon runner mid-race. It's a high-risk procedure that requires careful planning and execution. As we can see from this chart, the failure rate of digital transformation projects in the banking industry is alarmingly high. This highlights the need for a more careful and considered approach to modernization, one that takes into account the complexities of legacy systems and the risks of migration. So what's the takeaway from all of this? As a 20-year investor, it's essential to assess the infrastructure risk in your portfolio and prioritize reliability, transparency, and technical sustainability. It's not about chasing the latest innovation or trend, but about ensuring that the foundation of your investments is solid and secure. By taking a long-term view and focusing on the underlying systems and infrastructure, you can build a more stable and secure financial future.